Have you ever wondered why some people seem to build wealth effortlessly, while others struggle no matter how much they earn? The truth is, wealth isn't just about making money, it's about managing, growing, and protecting it. Picture this. You've got €10,000 tucked away in a savings account. It's earning an interest about 0.13%. You're probably thinking, it's safe, it's growing, slowly but surely. But here's the truth. Every single day, that money is losing value. Inflation is silently eating away at it. And what may feel like a smart and secure move is actually holding you back. In Ireland, where household wealth has almost tripled in the last decade, most of us are still falling into this trap. So ask yourself, do you want your savings to shrink in real time? Or do you want to take control and build real wealth? Hi, I'm Elliott, and welcome back to the channel. I help educate and empower people to make smart financial decisions, enabling them to build and preserve true wealth. If that's something you're after, whether you're saving for a home, planning for retirement, or just trying to get ahead, hit the like button and subscribe for more personal finance insights. Ireland's household wealth has almost tripled over the past decade. And according to the CSO, net household wealth now exceeds €1.2 trillion. This may seem like great news, but not all wealth is growing equally. The wealthiest 10% of Irish households control nearly half of this wealth. Meanwhile, the lower 50% of households hold a disproportionate amount of their financial assets in bank deposits rather than diversified investments. Here's the real issue. Depositing your savings in a low-interest account isn't safe. It is a guaranteed way to lose money over time. Irish households currently have a record €156 billion in bank deposits. That accounts for 19% of the total net household wealth. However, almost 90% of this money is sitting in easy access demand deposit accounts that pay an average of just 0.13%, according to a report from the Irish Examiner. Meanwhile, fixed-term deposit accounts are offering rates like 2.75% from Permanent TSB, or up to 3% from Bank of Ireland or platforms like Raisin Bank. But surprisingly, most of us are not making the switch. So how do we compare to other countries? Well, first, let's level the playing field. In Ireland, our personal wealth is dominated by property, with residential real estate making up a significant portion of household wealth. However, when we focus solely on financial assets, the percentage of Ireland's wealth held in deposits is around 25%, and that is comparable to our neighbours in the UK. Compared to other countries though, Ireland's deposit levels are relatively moderate. So for example, in Sweden and the Netherlands, households hold about 15 to 20% of their financial wealth in deposits. These countries tend to favour investments in stocks, bonds and pension funds over cash savings. In contrast, countries like Malta, Portugal and Greece have a much higher reliance on deposits, with as much as 70% of household wealth held in cash or savings account. This reflects a much more risk-averse savings culture and less developed financial markets. Japan stands out though, with over 50% of household financial wealth held in cash or deposits. This is driven by long-standing preference for liquidity and low-risk savings. The United States, on the other hand, is on the opposite end of the spectrum, where deposits make up only 10 to 15% of financial assets. This reflects a strong culture of investing in financial markets. So why do Irish people keep so much money in the bank? It's not just habit. Unlike the US, where stock market investing is second nature, Ireland has a low investment culture, with fewer people jumping into equities or other financial markets. Instead, we prioritize saving for property over diversifying. And when you add in a tax system that hits ETF gains with a 41% tax, it's no wonder that we stick to cash. But here's what most people don't realize. The bottom half of households hold 19% of their wealth in deposits, while the wealthiest 10% diversify into equities and business assets. That gap matters, and it's growing. Now here's the real problem. Inflation. Since Ireland joined the Eurozone in 1999, we essentially handed control of our monetary policy over to the European Central Bank, meaning we can't tweak interest rates ourselves anymore to fight rising prices. Inflation in Ireland has fluctuated over recent years. It went up to 8% in 2022, and even now, in February 2025, it sits just under the European Central Bank's target of 2%. For years, it's averaged between 3 to 5%, and that's a massive issue when your money is in low-interest accounts. Let's make it real. Say you've got 10,000 euro earning 0.13%. You'll make a grand total of 13 euro in a year. But at 1.8% inflation, that 10,000 euro drops to 9,820 in purchasing power. You're down 167 euro in real term without even touching it. Stretch that out for over 10 years at a steady 2% inflation rate, and your 10,000 euro shrinks to 8,172 euro in today's money. That's over 1,800 euro gone, silently shrinking your wealth. Take my neighbor John, a retiree living off 30,000 euro annually in savings. At 2% inflation, his money in real terms drops 600 euro per year. That's 2 less pints per week that he can afford. And if you want an interesting way to see inflation in action, let's look at the Guinness Index from Raisin Bank. It tracks how many pints of Guinness your weekly wage buys over time. A brilliant tool to assess purchasing power. So back in 2007, at the peak of the Celtic Tiger, the average weekly wage was 730 euro. That bought you 196 pints at 3.72 euro each. Fast forward to 2024, with the wages now at 922, you're down to 164 pints at 5.62 euro. 32 pints fewer than 17 years ago, even though your wages have increased. Pub prices have jumped 35% in the last decade, way outpacing your 0.13% savings rate. In 2025, a 6% wage bump brings it to 168 pints at 5.80 euro. That's inflation at work. Your money buys less even when you earn more. Even worse, the ECB President, Christine Lagarde, warned in March 2025 that trade disruptions, defense spending, and climate shocks could push inflation higher and make markets even more volatile. It could climb to 3 to 5%, and your savings could vanish even faster. You want to see how much money you're losing? Check out the inflation visual calculator from the CSO. It's a free tool that shows you exactly how inflation erodes your savings over time based on real Irish data. And here's how it works. You pop in your savings amount, say it's 10,000 euro. You pick a time frame, say 10 years, and it uses Ireland's historical inflation rates to calculate what your money is worth today. It's quick, easy, and it shows you the real damage in euros. I'll drop a link in the comments below. But inflation isn't the only issue. It's also about what your money could be doing instead of sitting in an account earning a small interest rate. Every euro sitting there is a euro not growing. So where should you put your cash if savings accounts are losing your money? I'm going to take into account taxes like the 33% dirt on deposits, 33% capital gains tax on properties and shares, and the 41% on index funds gains. I'll start with the safest option and I'll work a way up, because while these can offer higher returns, they also come with more risk. So first up is bonds. So think of these as a loan that you give to a company or the government, and they pay you back with interest. Irish government bonds or corporate bonds typically pay between a yield of about 3 to 5% annually. They're safer than stocks and are more stable than property. If you put 10,000 euro into a corporate bond averaging 4% in 2015, you would have about 13,217 today after taxes. That's 1,775 more than a 2% fixed term deposit, of which would give you 11,467 after tax. The risk, low. But if interest rates spike or the issuer struggles, you may not get the full return. Still, it's a better step up from cash. What about property investment? According to the CSO, residential property prices have increased 90% since 2015. If you had invested 10,000 euro in a rental property in 2015, it would be worth 15,940 post-capital gains tax in today's value, plus any rental income. That's a big jump from the 11,467 in deposits over the same period. But here's the problem. Property isn't liquid, you can't cash out quickly, and it's not risk-free. Prices crashed in 2008, and the maintenance and bad tenants could eat into your profits. Higher returns? Yes, but you're also taking on more certainty. Then there's stocks. Take the S&P 500, tracking the 500 top companies in the US. It has averaged over 10% annual return for decades. If you put 10,000 euro in S&P 500 ETF in 2015, you would have 19,408 today after applying the deemed disposal tax of 41%. Okay, so now for a wild example. Say you put 10,000 euro in Nvidia 10 years ago. It would be worth over 1.8 million euro after tax today. But that's an outlier, and most stocks aren't going to explode like that. The downside with stock, volatility. It certainly is higher reward, but it's definitely higher risk. So yes, investing carries risk, but over the long haul, diversified assets like stock market funds or ETFs, a small step into bonds significantly outperforms cash. In the US, people are twice as likely to pick funds over deposits. Here, we're missing out on that potential growth. Even small moves can make a big difference. But Kevin, deposits are safe. Well, not entirely. The deposit guarantee scheme only covers €100,000 per person per bank. If you've got more than that, you're exposed if the bank fails. Rare, but not impossible after what happened in 2008. And keeping wealth and low yield accounts limits your flexibility for big moves, like buying a home or starting a business. True safety comes from growth, not from preservation. So how do you stop this silent killer? Start here. Step number 1 is to check your rate. If it's below 1%, you're losing. A brilliant tool that is not used widely enough is the Competition and Consumer Protection Commission's deposit comparison tool. I'll link it below and maybe do a quick video in a future video. It's simple. Enter your savings amount, pick instant access, a notice account or a fixed term account. And if you choose the notice account or fixed term account, you will select your investment time horizon. And the tool will show you the latest offerings from financial institutions based in Ireland. Rates and products change all the time, so this helps you find what's best for you right now. Step number 2 is to go fixed term. Shift some of your cash to fixed term. EIB's fixed term offers at 2.77% if the cash is committed for a minimum of 12 months. Step 3 is to try state savings. AmPost savings certificates are tax-free and secure, and they're great for beginners. Step 4 is always to ensure you have an emergency fund. Keep 3 to 6 months expenses liquid, then invest the rest. And step 5 is to start investing. A low-cost ETF like the S&P 500 could turn €500 invested monthly into $260,000 in 20 years at 7%. Move at your pace, but make sure to stay moving. Here's the deal. Deposits feel secure, but inflation is silently killing your wealth. Ireland's cash habit is holding us back from the growth that the richest enjoy. Small, smart steps can protect and grow your money. This is about balance, security, and growth. That is true wealth. So what's your next move? Are you sticking with deposits or are you ready to diversify? Tell me in the comments below. I love to hear. If this video helped you spot that silent killer, like, subscribe, and share it with someone who needs that wake-up call. Oh, and if you're curious about starting investing and you don't know where to begin, check out my beginner's guide to investing video that's already posted on the channel. It breaks down the basics to get you going. Together, we're building financial freedom. See you next time.